We're delighted with the results. Obviously record results for Regional REIT, a total return of 16.6% in the financial year ending 31st December 2018. Of that, we saw increased occupancy up towards our target of 90%. We've also seen an increase in NAV, substantial increase in NAV, through some of our strategic selling last year, and particularly the sale of 40% of our industrial portfolio, a counter-cyclical move that produced 25% over current valuations, so very successful policy. We've also announced an increase in dividends to 8.05 pence per share, up from 7.85 pence per share, so 3% up on the previous financial year. And the board continues with progressive dividend policy. Dividend in the current year, 2019, will be back to fully covered. Last year, slightly undercovered, 93%, simply because of the sales activity generating substantial profits for the business. We've also managed to bring the LTV down from 45% year ending 2017 to below our target threshold of 40%. So a substantial movement in that financial year. The benefits of the repositioning are quite clear to see. Our occupancy is up, obviously. We're 92% in our core markets of offices and industrial, so very little exposure to retail, which is very good in the current climate. We have been continually recycling. Our sales averaged in 2018 a net initial yield of 5.7%, acquisitions 8.7%, so a very substantial arbitrage, which is what you would expect to see. We buy undervalued, undermanaged assets using our extensive platform, our unique platform actually. We do everything from property management through to financial management and all things in between. And by utilising that platform, we're able to generate substantial capital improvements through income improvement. Following the sales activity, we've been successful in reinvesting the proceeds of those sales in mainly offices, particularly in the southeast and southwest, target locations for us, because we expect to see higher rental growth in those office markets over the course of the coming few years. I think that's borne out by the vast majority of market commentators. And whilst I never like to assume growth, I think given the supply-demand dynamics in those locations, we are expecting substantial rental growth in the short to medium term. Our corporate finance team have continued to be successful in extending our debt facilities. Average debt maturity currently stands at over 7 years, an average cost of 3.5%. So given a relatively short WALT of 3.5 years, that's a substantial improvement in our debt position. And indeed, there are 2 small debt renegotiations going on just now, which should take us to 8 years maturity, again continuing that average cost at 3.5%. So this is in a very strong position with no interest rate risk, given that all of our debt will be fixed or hedged. Well, it's business as usual for Regional REIT. We will continue to work our portfolio hard, driving income returns through our asset management initiatives that are ongoing. We've obviously been very successful in making lettings announcements over the course of the first couple of months of 2019, following refurbishment projects in Birmingham and Bristol. That will continue. So we're expecting continued earnings growth through rental income. At the same time, we continue to seek out new investment opportunities. We have some resources to deploy. We announced the acquisition of Norfolk House, Birmingham in January of this year, a 20 million strategic purchase in the heart of Birmingham city centre. And there will be further acquisitions and sales over the course of 2019 as we continue to dispose of our non-core assets and reinvest those proceeds into earnings-enhancing core assets. Regional REIT are well positioned. Our office and industrial portfolios are in the right location to benefit from rental growth over the course of 2019. Supply-demand dynamics remain in our favour. Continuing strong demand, very limited supply, falling total stocks in both industrial and office markets as buildings are repurposed for alternative uses. We continue to find a whole stream of opportunities. We've been very successful in doing off-market deals over the course of the last 2 or 3 years, and that continues. We're seen as a preferred buyer, just be given our track record. So we are seeing all opportunities in our sector and currently deciding which ones we want to to take forward and not. So the outlook for 2019 is as strong as ever. We'll continue to produce total returns of 10% plus, which is what we've always promised our shareholders, and it delivered, average over 10% over the first 3 years of the life of the fund. So the outlook is very rosy.